So what are futures? Well, for many people, trading futures may seem like a foreign and intimidating topic. If you have been educated in the stock market or have traded other asset classes in the past, futures may seem complicated, frightening, and even uncertain. But in our opinion, there is no need to feel that way. Even though the futures market has some differences with other asset classes, we believe they are not more complicated. Having a basic understanding of how futures contracts work is essential if you plan to trade them. As a futures trader, you are buying and selling contracts. Another word for futures is forward contracts. Futures contracts are contracts that are to be executed in the future. So here's an example of how this works. Farmer Jim is a producer, and what Farmer Jim produces is corn. Corn is his product or commodity that he hopes to make a profit from by selling his product. Now, this corn cannot be sold until it grows and is harvested. This presents a unique problem for Farmer Jim since the corn prices can change drastically between planting and harvesting. As Farmer Jim tends to his crop in anticipation of selling, he will be keeping a close eye on the current price for his commodity. If the price of corn drops before he can get his harvest to the public, he will lose money when it comes time to sell. Farmer Jim's corn will not be ready for 3 months. And during this time, there is a potential for the price of corn to plummet based on several factors. The next entity we will introduce is Richard's Corn Muffin Factory, which manufactures corn muffins. Richard's Corn Muffin Factory produces corn muffins from locally grown corn and makes agreements with corn producers in that area. The producer understands that corn takes about 3 months to grow before it is ready to be sent over, but there is a genuine concern that the price of corn may increase during that time, which would make the corn muffins become more expensive. Both the producer and the manufacturer have specific needs. Farmer Jim wants to sell his corn before it's ready so he can lock in a profitable selling price. Richard's Corn Muffin Factory wants to buy that corn as cheaply as possible before the price skyrockets. So how do these two entities with seemingly polar opposite needs accomplish their goals? They enter into a mutually beneficial contract. The contract develops as such. Farmer Jim approaches Richard's Corn Muffin Factory with an offer to sell his corn crop for $10,000 US. The caveat is that Farmer Jim won't be able to deliver the corn for 3 months. Richard's Corn Muffin Factory is happy to purchase the corn at such a reasonable price and agrees to Farmer Jim's terms, but stipulates they won't be able to pay until that corn is delivered. Now that the terms of the contract are set and agreed upon, the two entities have made the contract official. They sign the agreement, which has an agreed upon set price, regardless of what happens to the price of corn at the end of the 3 months. Even if the cost of corn plummets or skyrockets, both entities are contractually obligated to follow the agreed upon terms. If all goes well, Farmer Jim will harvest the corn and deliver it to Richard's Corn Muffin Factory in 3 months, which then Farmer Jim will collect $10,000 US for the crop, which fulfills the contracts. With the contract signed under a future fulfillment date, it is now a forward or future contract. Now let's look at one of the more interesting aspects of futures contracts. Farmer Jim and Richard's Corn Muffin Factory entered into that agreement with clear stipulations. However, both entities have the opportunity to sell their side of the contract to outside parties. Let's assume that 2 months into the agreement, Farmer Jim's corn is now worth $30,000. The value of the corn has risen substantially by about $20,000 US, and Richard's Corn Muffin Factory will only have to pay the original $10,000 US. Knowing that the corn's value has increased, Richard's Corn Muffin Factory can decide to sell their interest in the contract and pocket the $20,000 US difference. Farmer Jim now realizes that the agreement to sell the corn at $10,000 is now negative and that he's actually losing money from this transaction. he decided to sell his side of his obligation and is losing money from this transaction. He decides to sell his side of the obligation, provide basically that original $10,000 contract to someone else, expecting a loss from the original transaction. Farmer Jim can then hope to make some money by selling corn in another deal or increase the price. That is how futures contract works at its core. Buyers and sellers enter into agreements set to be fulfilled at a future date at a locked-in price, regardless of what happens in the market, and the contract matures. The producer and the manufacturer can sell their side of the contract before the execution date if the value of the contract changes to another entity that is willing to buy that side of the contract. One crucial detail to remember in this example is that the new producer is still obligated to deliver the corn, and the new manufacturer is still obligated to buy and receive all the corn. Though the above example involves farming, you can pretty much trade futures contracts on any symbol, and most industry sectors give you the ability to trade futures contracts. Futures trading is a common practice within the market. As a futures trader, one of your most essential actions is monitoring price movements of commodities over time. To accomplish this, you'll use open price, the close price, high price, and low price during a specified time. But the question now comes is, where exactly do you trade the futures? You're not a manufacturer. You're not a producer. You're just an individual trying to make some money online, which means you need an entity to facilitate these transactions. That is where the broker comes in, and we will be covering that in the next video.